Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. Policy storms and portfolio peace. When governments create chaos, investors need calm. The last few days have provided a full tutorial on how quickly policy announcements can send markets into a frenzy. The sudden imposition of a $1 lakh fee on new H-1B visa applications caught everyone off guard, from tech companies scrambling to get their employees back to the United States before the deadline, to Indian IT stocks declining due to fears of massive cost increases. Add this to the erratic US trade policy we've witnessed over recent months, and I don't really blame you for anxiety. It's natural to feel unsettled when policy changes seem to emerge without warning. The H-1B announcement gave companies just 2 days to adjust, creating scenes of chaos at airports as employees rushed to return before the new rules took effect. For Indian investors watching their favorite IT stocks decline, the temptation to panic sell or dramatically reshape portfolios is understandable. But this is precisely when disciplined investing principles matter most. The fundamental mistake many investors make during such episodes is confusing noise with signal. Yes, a $1 lakh annual fee per H-1B worker is significant. Yes, it will impact the cost structures of companies that heavily rely on foreign talent. But does this single policy change fundamentally alter the long-term prospects of well-managed technology companies? Almost certainly not. Think of what actually happened with the H-1B announcement. Within 48 hours, clarifications emerged that the fee applies only to new applications for workers outside the United States, not renewals or current visa holders. Large technology companies, despite their initial concerns, quickly adapted their strategies. Some accelerated existing plans to hire locally, and others adjusted their global workforce distribution. The market's initial panic reaction looked increasingly overdone as more details emerged. This pattern repeats itself with remarkable consistency across different policy announcements. Markets react dramatically to the headline, often ignoring the practical details that emerge later. Investors who sell in panic during the initial reaction frequently find themselves buying back at higher prices once the dust settles and calmer analysis prevails. The broader context of trade policy uncertainty exacerbates this challenge. Tariffs announced one day might be modified the next. Emergency measures declared with great fanfare often get watered down through subsequent negotiations. The result is a constant stream of seemingly important announcements that create short-term volatility but rarely deliver the dramatic long-term changes initially feared. This doesn't mean policy changes are irrelevant to investment decisions. They absolutely matter. But their impact is usually more gradual and complex than initial market reactions suggest. Moreover, there are always second and third order effects, some of which are in the opposite direction from the original news. The practical approach is to focus on what you can control rather than what you cannot. You cannot predict the next policy announcement or its market impact. You can, however, ensure your investment portfolio is diversified across different sectors, geographies, and time horizons. You can stick to companies with strong fundamentals that have demonstrated resilience through previous policy cycles. You can maintain the discipline to buy quality businesses when panic selling makes them temporarily cheaper. Policy uncertainty will always be present, sometimes more pronounced than others. The current period may feel particularly chaotic, but it's worth remembering that markets have survived and thrived through far worse policy environments. Companies adapt, economies adjust, and patient investors who focus on long-term fundamentals rather than short-term headlines generally emerge better off. The H-1B episode serves as a poignant reminder of this truth. What seemed like a market-moving crisis on day 1 appeared to be a manageable business challenge by day 3. For investors, the lesson is simple and rather boring. When policy becomes erratic, portfolio peace comes from staying focused on what truly matters for long-term wealth creation.